Hello, and welcome back to the channel. I'm Algabot, and today we're taking a close, educational look at a pure price action expert advisor for MetaTrader 5 called Twin Close Sandwich Reversal. This strategy uses no indicators at all. Instead, it reads a classic three-candle chart pattern known as the stick sandwich, where two matching closes wrap around an opposite-colored bar to mark a level the market has tested twice. Over the next few minutes, we'll explore how the pattern is defined, how the code detects it, how the stop and target are placed, and we'll walk through example long and short setups on a chart. Let's begin. So what exactly does this expert advisor do? Twin Close Sandwich Reversal is a reversal system built entirely on price action. It watches for a specific three-candle formation, the stick sandwich, and it treats that formation as evidence that the market has tested a level twice and held it. There are no technical indicators involved. No moving averages, no oscillators, no momentum lines. The only calculation under the hood is a simple average of recent bar ranges, and that average is used purely to scale the pattern's tolerances to whatever instrument and time frame you attach it to. Because it's pure price action, the strategy is symbol agnostic. It can be studied on foreign exchange pairs like euro versus US dollar, on indices, on metals, or on any market that produces clean candlestick data. It works on whatever time frame the chart is set to, evaluating the pattern once per closed bar so it never acts on an unfinished candle. The trading style here is countertrend and structural. Rather than chasing momentum, the strategy looks for exhaustion, a decline that reaches a floor the market refuses to break, or an advance that stalls at a ceiling it cannot clear. It then positions for a turn, with a stop placed just beyond the structure that defined the level, and a target set as a fixed multiple of that risk. Who is this style suited to, in an educational sense? It tends to appeal to patient, price action-minded traders who prefer clearly defined setups over discretionary judgment, and who are comfortable with the reality that reversal patterns fail regularly. Trading always involves risk, and losses are a normal part of any approach. Everything here is shared to help you understand how the logic is constructed, not as advice to trade it. With that framing in place, let's open up the mechanics. Let's walk through the mechanics step by step. First, the expert advisor only acts on a freshly closed bar. On every tick it checks whether a new bar has opened, and if not, it simply waits. This keeps the pattern evaluation stable and avoids reacting to a candle that is still forming. It also confirms there is enough bar history to work with, and it allows only one open position at a time for its magic number, letting the stop-loss and take-profit manage each trade to completion. Next, the strategy identifies the three most recently closed bars. The oldest of the three defines the shelf, the middle bar is the sandwich filling, and the most recent bar is the one that closes back onto the shelf. It then measures the average bar range over the range period, which defaults to 14 bars. From that average, it derives three scaled thresholds, a close match tolerance, a required middle bar excursion, and a structural stop buffer. The shelf itself is the midpoint between the first bar's close and the last bar's close. For a bullish sandwich, the strategy checks several conditions together. The first and third bars must both be bearish, the middle bar must be bullish, and that middle bar must close at least a set distance above the shelf, by default 45% of the average range, so the filling genuinely lifts off the floor. The first and third closes must match within the tolerance, which defaults to 12% of the average range. And crucially, the shared low of all three bars must be a fresh swing low over the look-back window, which defaults to 20 bars. When every condition is met, the strategy signals along. Entry is taken at the ask price. The stop-loss is placed just below the lowest low of the trio, minus the buffer. The distance from entry to stop becomes the measured risk, and the take profit is projected above entry by the reward-to-risk multiple, which defaults to 2. So a 1-unit risk aims for a 2-unit target. The bearish sandwich is the exact mirror. The first and third bars are bullish. The middle bar is bearish and closes well below the shelf. The two closes match at a ceiling, and the shared high must be a fresh swing high. Entry is taken at the bid. The stop sits just above the highest high plus the buffer, and the target again projects the reward-to-risk multiple below entry. In both directions, once a position is open, there is no further management. The stop and target define the exit. Let's look at how this reads in MetaEditor. At the top are the input parameters. Look-back bars, defaulting to 20, sets how far back the swing check looks. CloseTolerancePct, at 12, controls how tightly the two closes must match as a share of average range. MinMiddlePct, at 45, is how far the middle bar must travel off the shelf. Stop Buffer%, at 25, cushions the structural stop. RewardRisk, at 2, sets the target as a multiple of risk. Range Period, at 14, is the averaging window, and Lots sets the trade volume. Below that, the shelf is computed as the midpoint of the first and third closes. The bullish block checks that the first and third bars are bearish. The middle bar is bullish. That middle close sits at least the minimum distance above the shelf. The two closes match with intolerance, and the trio low is a fresh swing low. When that condition is true, the code reads the ask price, sets the stop below the trio low minus the buffer, measures the risk, computes the target at reward risk times that risk, and calls trade.buy with those stop and target levels. The bearish block is the mirror. It confirms the first and third bars are bullish. The middle bar is bearish and closes below the shelf by the minimum amount. The closes match, and the trio high is a fresh swing high. Then it reads the bid, sets the stop above the trio high plus the buffer, computes the target below entry, and calls trade.sell. Both sides hand the exit entirely to the stop and target. Let's bring the logic to life on a chart. On the left, price is sliding lower in a steady decline. Notice the green dash line. That's the twin close floor at 1.0840, the level our pattern is about to defend. Watch the three candles that form the setup. The first bar of the trio is bearish, closing right down onto that floor. The middle bar is bullish and pushes well above it. This is the opposite colored filling of the sandwich, and the strategy requires it to rise a meaningful distance off the floor, at least 45% of the recent average bar range. Then the third bar turns bearish again and closes back down almost exactly onto the first bar's close, right at 1.0840. Those two match closes, wrapped around the raised middle bar, are the stick sandwich. Because the shared low of the trio is a fresh swing low, the lowest point over the look-back window of 20 bars, the strategy reads this as a twice-defended floor at the bottom of the decline. On the next bar, the buy entry marker appears. The stop-loss sits just below the trio's lowest low, cushioned by a small buffer, and the take-profit is placed at twice that risk distance, a reward-to-risk multiple of 2 to 1. Now follow the candles that come after. Price lifts off the floor, one bullish bar after another, climbing away from the defended level. The move carries up through the target, and the take-profit marker is reached. That completes the long example, a reversal bought at a floor the market tested twice and held. Now the mirror image plays out near the top. Price has rallied into a fresh high, and the red dashed line marks the twin close ceiling at 1.0895. Again, three candles form the pattern. The first bar is bullish, closing up at the ceiling. The middle bar is bearish and drops well below it, the opposite colored filling on the short side. The third bar turns bullish again and closes back up almost exactly onto the first bar's close, right at 1.0895. Twin closes at the ceiling. Because the shared high of the trio is a fresh swing high over the look-back window, the strategy reads this as a twice-rejected ceiling at the top of the advance. On the following bar, the sell entry marker appears. Here the stop-loss sits just above the trio's highest high plus the buffer, and the take-profit again projects twice that risk below the entry, keeping the same 2 to 1 reward-to-risk shape. From there, price rolls over. One bearish candle follows another as the market turns down from the ceiling, and the move runs into the short take-profit marker. That completes the short example. Notice what did and did not matter here. There was no oscillator, no moving average, no momentum reading. Every decision came from the raw candles. Two matching closes, an opposite colored bar between them, and a fresh swing extreme, with the average bar range setting how tight the close match had to be and how far the middle bar had to travel. The stop always sits beyond the structural extreme of the pattern, and the target is simply a fixed multiple of that measured risk. It's a clean, self-contained way to define a reversal, and it shows why price action traders value patterns that carry their own stop and target built right into the structure. That brings us to the end of our walkthrough. We covered how the twin close sandwich reversal expert advisor reads a three-candle stick sandwich pattern, how it defines a floor or a ceiling from two match closes at a fresh swing extreme, how it places its structural stop, and how it projects a target as a fixed multiple of risk. We also stepped through the code and traced example long and short setups on the chart. Remember, everything in this video is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses do occur. If you found this analysis helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment with strategies you'd like explored next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.